Hey guys, it's Brandon here, and in today's video, I'm going to teach you how to read between the lines when it comes to analyzing the trade area of a multifamily property. I'm going to take you into the Atlantic Holiday again. We're going to dive into the market analysis of the trade area. I'm going to show you that it's oversupplied, and then I'm going to teach you how to find and identify the needle in the haystack and read through all that noise in the trade area for you so that you can recognize a savvy investment. Now, I don't want to hold us up. Let's get into the video now. You'd like to invest in commercial real estate. I'd like to show you how these properties make profit and break down all their expenses so you understand how they operate, how they appreciate over time, and how this will impact your taxes. I'd also like to let you know the property's cap rate and how it compares with similar properties in the market, how the location best services its users, and the potential for future growth. I'd like to fill you in on the historical and future occupancy trends, as well as potential management structures affecting the investment. And we won't miss the investment's risk profile nor the best exit strategies. Yes, we'll cover the condition of the property, any value add potential, and repositioning, but we'll also dive into special topics like customer base, market positioning, and marketing and booking strategies when it applies. And if you stay tuned until the end, I'll show you my top picks for the best commercial real estate deals that have generated the most annual profits, have the highest appreciation, and the best tax implications. So no matter if you're a first-time investor or a seasoned professional transitioning into the real estate game, or perhaps simply a casual investor looking to relocate to the beach to live, play, and invest so that the passive income can support you in your retirement years, whether you have 20% to pay down because you're financing or you're a cash buyer, if it's a commercial real estate investment that you're after, you'll be better because I'm aiming to give you a 10 times return on your time for watching my videos until the end. All right, guys, now we are just outside of what's called the Atlantic Holiday. As you can see there, Atlantic Holiday, it is a multifamily building, 21 units, right here, just a few blocks away from the ocean. As you can see here, we're 2 streets from the ocean. That's the ocean water right there, way up there. Now, right there is a major highway, a major road in our community called North Kings Highway. Tons of traffic there. But as you can see, once these cars get done coming by, as you can see, this is definitely a highly sought after area due to its location and proximity to the beach. Now, I'll walk you up. There is a pool. The pool is currently closed. But as you can see here, 21 different units. You have some storage here. Trash. This is the side street. I'll take you around so you can see what's back behind it. And the rear of the building, as you can see here. .5% occupancy right here at the Atlantic Holiday. As you can see, I'm going to carry you just around to the other side and walk you to the road so you can see the heavy traffic area that we're in. This is the other side of that building, as you can see. Now this is what's here. Got a really cool Pacific Beach, we're across the street. There's another store here to my left. And South Kings Highway, correction, not North Kings Highway, South Kings Highway. Smoke Life Vape. You have a Mexican restaurant here. Once I get up here just a little bit, guys, I'll stop and kind of zoom in so you can see the traffic and the stores around. So we got the entrance to the KOA campground. You can see that right there. Specific Superstore there. And then across the street, we have a Specific Beachwear. Smoke Life right here. Mexican restaurant. Then as you can see across the street, you have a nice little plaza with Thorny's, liquor store, Check and Go, Dollar Tree across the street. And you see all the heavy traffic. Excellent, excellent location. Let's get on unit 205. Now we step into unit 205, you're gonna notice there's just a refrigerator sitting there. But you can see how wide open it is. Kitchen in this corner. And then the restroom. All right, now what I want to show you about the Atlantic Holiday is how to calculate either the surplus or the gap when it comes to multifamily property demand in a given trade area. So the first calculation that we're going to do is going to be the current rental demand. Now, ultimately, we're going to find out what the total population is, which you can see from our infographic is 20,242. We're going to subtract out group quarters. Now, group quarters are non-household population, military-based people, or on-campus student housing. Those are people that would not be included in a household. By the way, you don't calculate multifamily demand based on population alone. You calculate it based off of households. Now, we'll take the total population at 20,424. We're going to subtract out the group quarters because those people aren't in households that would be part of the demand to rent a multifamily property. Obviously, they're on a military base. They're on a student campus. They are, wherever they are. Anyways, so we take the total population, we subtract out the group quarters, and we're left with household population. That's 20,223. Now, we need to know what the number of people per household is in the trade area. On our infographic, the average household size is 2.2. So then we're going to take that number, the household population of 20,223, we're going to divide it by the average household size of 2.2, and we're going to find out that there are occupied households in the trade area to the tune of 9,192. Now, that's an important number. Next, we're going to find out what the renter-owner ratio or the tenure is, or tenure, excuse me. And basically, we'll take the renter-occupied housing units, which were 4,723, which you can see on the infographic that I pulled in the site to do business for the trade area. And then we're going to divide it by the total housing units in that trade area. And that's going to give us a renter-owner ratio or a tenure of 40.7 or 0.407. Now, we're simply going to take that ratio tenure and we're going to multiply it by the current number of occupied households in that trade area. And that's going to let us know what the occupied rental households are out of the occupied households in the trade area. So all that being said, when we multiply 9,192 by 0.407, we're left with occupied rental households to the tune of 3,738 in that trade area. Now, we obviously have to gross that number up for vacancy. So we figure out what the vacancy is in the general area, in the trade area. For our information here, I just used the vacancy rate for the subject property, which was 92.5%. So we have to gross that number up to account for vacancy because there has to be some level of vacancy in the trade area, because if not, people, there would be no room for growth. People would just be moving out of the trade area, out of the trade area altogether, and they wouldn't be moving into the trade area if there wasn't room for vacancy, if that makes any sense. So obviously, if nothing's vacant in the trade area, they have no choice. They can't move into the trade area. They can only move out of the trade area. Well, we know that that's not the case. There is a market average vacancy and there's a trade area vacancy. Again, I just applied the subject property vacancy rate. It was occupied to the tune of 92.5%. We grossed that number up, and now we've taken the occupied rental households and we've increased them to 4,041, taking into account vacancy, because we know realistically people are moving into the trade area. Okay, now, that's our first calculation. We've officially arrived at the total rental demand in households in the trade area. Next, we're going to calculate the rental vacancy calculation. Now, we're going to take the total vacant housing units. Again, it's right here in our infographic that I ran for the area of 2,567. We're going to multiply that by the renter-owner ratio, or your tenure. Again, that's 0.407, and that's going to give us the total vacant renter units that are out of the total vacant housing units altogether. So there's a current amount of vacancy in the trade area to the tune of 1,044. Now let's just kind of backtrack and make sure we're all staying on the same page. The total rental demand in households is 4,041. The total renter units that are vacant in the trade area are 1,044. Now let's keep going. Next, we're going to calculate our rental supply calculation. Now, this is going to be the renter-occupied housing units, which was 4,723, which we found from our infographic in the site to do business. We're going to subtract out the vacant units from that, which was 1,044. We just figured that number out. Excuse me. We're going to add in those numbers. We're going to add in the total vacant units, and that's going to give us a total renter housing units of 5,767. So we know that there's a supply in the trade area to the tune of 5,767 renter units. It's that simple. Now, if we take the total households that are in demand in the trade area, our very first calculation, which was 4,041, and we subtract out our total rental units of supply that we have in the trade area, which was 5,767, we are left with an oversupply and not a gap of 1,726 units. In other words, if you're just using this one metric to calculate whether or not there's demand in the trade area for this product type, then it would indicate that there's not. This multifamily property is going to have stable rental income in the next 5 years, in the next 7 years, because everything that's being built or has been built in that trade area is servicing a different person altogether that's paying $1,700 a month for rent. So while there may be an oversupply in that $1,750 rental market, there may in fact be an undersupply in the affordable rental market. But more on that soon. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, because over 90,600 people relocated to Myrtle Beach, South Carolina in 2023 alone. This means increased demand for commercial space like retail, multifamily, office, and industrial, and ultimately excellent annual profits and appreciation. Now, for retail, more residents equal more consumers equal higher rental sales potential. This drives up rents and occupancy in retail centers. For multifamily, higher population boosts demand for rental housing, pushing rents up and lowering vacancy. Now, for office, job growth typically follows population growth, increasing demand for office space. For industrial, more people means more consumption and e-commerce activity, increasing warehouse and last mile logistics demand. Ultimately, the return on investment impact is higher rents, lower vacancy, and rising property values that drive higher net operating income and appreciation. I believe you should invest in commercial or real estate in Myrtle Beach, South Carolina, especially oceanfront hotels in the hospitality industry, because of the 20 to 22 million tourists that visit our market each year, which is the #2 vacation destination on the East Coast. High tourism equals steady demand, making it one of the most visited beach destinations in the United States. Our oceanfront hotels benefit from consistent seasonal occupancy, premium nightly rates compared to inland properties, and repeat visitors, including families, snowbirds, and golfers. All right, so let's hammer away at what's really going on. And I've got some notes here, so I'm going to be doing some reading because I really, really want you to get this understanding. All right, so here's the strategic implication of a multifamily property that's located in a trade area that's oversupplied, but the subject property has an occupancy rate of 92.5%. Guys, it's a clear winner. In an oversupplied market, it is dominating the competition. You got to read between the lines. You can't run off and go, oh, well, the market's oversupplied, so, this isn't a good investment. Really? Well, let's dig in a little bit deeper to the nuts and bolts. On the surface, that holds true. Well, the market's oversupplied. It's probably not a good investment. Let's keep moving. But if you dig deeper and you find out, hey, this place has got a 92.5% occupancy rate in an oversupplied market. Wow, what's going on here? This property is stabilized. This property is beating the competition. Wow. All right, so oversupply creates noise. The property itself is the signal that you want to look for. It proves its competitive advantage by what it's already doing. It's commanding higher occupancy rates in a renter's market. So here we are. The market's oversupplied. It favors the renter because it's oversupplied, yet this property's got a 92.5% occupancy rate. It's beating the market in a renter's market. Now, if you're an investor or a lender, you're basically not betting on hope. You're betting on a proven performer with a measurable edge in a crowded field. That's what's happening here. It's like we're actually about to get into it. I won't go there yet. All right. So now, the strategic implication is oversupply creates noise. This property is the signal. Now, in real estate investing, especially in multifamily, oversupply can distort perception. It introduces noise into the market, headlines that scream softening demand, too many units, or unsustainable construction pipelines. In that environment, most assets become undifferentiated commodities, and investors start pricing deals with a broad brush sense of caution. And that's probably exactly what's going on right now in the midst of our market. That's how you're seeing this investment. But this property cuts through the noise. It is the signal, a high-performing outlier that proves it has a competitive moat even when the market tilts against landlords. Now, why this matters. All right, so number one, occupancy is the real-time scoreboard. While many developers rely on rent projections or pro forma absorption, this property is already executing. 92.5% occupancy in an oversupplied environment is not a fluke. It's market validation. The market is literally validating the product. It's saying, hey, we like this so much that we are buying up as much of it as we can get our hands on. That's what you want to invest in. That's a smart move. Now, it tells investors where the demand actually is, not where developers hope it will be. In a market flooded with options, renters are still choosing this asset again and again. That's behavioral proof that the product fits the need better than most competing supply. If the majority of the supply in the market is serving $1,750 rents and higher, but we've got this low-end product that's serving a cheaper demographic and its occupancy is way up there, guys, we've got a sure winner. You got to read between the lines. So ultimately, this tells investors where the demand actually is. Demand is in the lower end segment, hands down. Now, All right, number 3, it points to pricing power and revenue resilience. A stabilized asset in a competitive market has a degree of rent resiliency. If others are discounting or offering concessions, but this property holds occupancy and collections, it's more likely to preserve income even during a downturn. Resiliency. Everybody's uncertain about what's going to happen in the future. Are we in a recession? Is the market deflating? Are prices dropping? You've got a stabilized asset right here with market resiliency. Number 4, it de-risks the investment thesis. You're not underwriting future success. In other words, nobody said this property can do this amount of money. We're saying this property is currently doing this amount of money. So this is not based on some future success that you've got to go out there and create. All right, you're not underwriting future success. You're investing in proven operational execution. That's a critical distinction for lenders, equity partners, or limited partners evaluating a buy in a saturated trade area. Number 5, it reveals embedded inefficiencies in the market. If this property, same kind of thing. If this property outperforms in an oversupplied zone, it suggests the average market stats are misleading. Completely agree. There may be poorly managed assets dragging down the overall picture, and savvy investors can capitalize on that mispricing. If there's a ton of properties that are supplying product at a higher price, and there's not very many supplying at a lower price, you've got a stable asset without much competition. Long term, I don't got to worry about my money 5 years up the road. Now, unless, of course, they start building low-end product there. Now, obviously. Now, think like a hedge fund. Alpha versus beta. I wanted you to get this. I wanted you to get this. All right. In this analogy, the market or the trade area equals beta. Overall performance, average trends, oversupply, etc. This property equals alpha. Above market performance due to design, location, operations, or branding. Most investors are afraid of the beta risk, too much supply, declining rents. But this property generates alpha, regardless of the beta environment. That's the kind of asset you want in your portfolio. It outperforms not just because the market is hot, but because it's fundamentally better. And that's what you want in your portfolio, guys. It's not up and down doing whatever the market's doing. It's a solid, consistent, reliable, stable, resilient performer. Here's your takeaway. When others see oversupply and stay on the sidelines, this is where smart capital gets to work. This property is a statistical anomaly that can be explained and monetized. It's not the kind of deal you find when your market is calm. It's the kind of deal that stands out when others are scared. You're not betting on hope here. You're backing performance. So ultimately, we're not asking you to invest in a property that isn't performing, isn't executing. We're asking you to bet on a sure winner that's already winning and beating out an oversupplied trade area. It's that simple and that easy.